let's move a little bit and explain one of the most important things for each individual going into a startup or looking for funding for his business. The 10 most common reasons why investors reject proposals. Poor writing and communication skills. When you want to present a certain project, a certain proposal, you need to know how you are writing the proposal. You need to know how you are presenting the proposal. You have to establish yourself and sell yourself when you are presenting the proposal. Untrustworthy. You have to work on your looks. You have to create the trust in you, because the investors, if they do not trust you, they will not give you your money. They need to start by trusting you to decide whether to give you your money, to decide whether they will listen to your proposal as you continue. The inability to respond well to comments. This is one of the most important reasons why investors, they might reject proposals. Investors are there to listen. They need to give you comments. They need to ask you questions to clarify. They need to ask some clarifications about your proposal. What do you mean by this? What do you want to say with this? And of course, they need to give you some criticism. You have to be in a positive mental attitude. You have to be cooperative and accept the criticism. If you do not accept the criticism, the investors, before starting, they will decide not to take the proposal, to reject the proposal, because you do not accept what they are saying. You do not accept their comment. You don't know how to answer their questions. You're not clarifying your proposal. Something which is very important, you have to be very simple, very clear in your proposal. Don't make it too complex. Don't make that proposal unreadable, ununderstandable. Make it simple. Make your comments, make your notes straight to the point. Don't create loops and loops to make them lost. Inadequate information. This is one of the important things that I need to reflect upon. We have to look at the information that you are putting into your proposal. You have to prove that you have a track record. You have to show them that you have a track record. You have to work on your proof of concept. Let me reflect a little bit on the proof of concept. The proof of concept in itself is the usefulness and the necessity of a certain product. You have to convince them that your product is a successful product, that your product is useful, and it is a necessity. It is needed in the market. If you want to get a loan for your business, you need facts and numbers so the bank can see what the profitability of your plan might be. This is the proof of concept. To make a good proof of concept, you have to find out as much as possible about what market it will serve. You have to show the investors what are you trying to do with your proposal, your product, your service, what market it will serve, how many people may be interested in it. So it's a simple research that you have to do in order to convince the investors that your product, your service has a market. It can be sold. It will be profitable at one point in time. As for the market awareness, I have to talk about it a little bit. Market awareness is very important. It is in the market awareness where you identify the factors surrounding the decision influencing, the decision making, and the purchasing behavior associated with the sales and marketing of your organization's product and service. In the market awareness, you have to talk about the brand awareness, about your product awareness, how the market will know about your product and whether they know and they need your product. Again, one important thing where investors might reject a proposal is the lack of management and business expertise. You have to show investors that you have experience. You know what you are talking about. You know how to run the business. You know how to make the business successful. You have to know about the bits and pieces, the ins and outs of your business. This is, as you answer the questions above, you will show them that you know what you are talking about. You have experience in what you are trying to convince them in your proposal. Investors, when they try to fund you or they try to help you in their investment in financing your project, they have to see in you some willingness to share equity and to become partner with them in order to help you. Investors, they need to know if they can become partners with you and help you in the control and the management of your business. If you don't have the willingness to share equity, if you don't have the willingness to reduce the control of your business, to make someone help you in the control of your business, investors at that stage, they will become reluctant. They say, no, I prefer to become your partner. I prefer to become your partner in the management and the control of your business. If you don't want someone to help you, if you don't want someone to become your partner, these investors will say, well, it's your decision. We will reject the proposal. Again, when you talk about the financial planning, about the financial projections, you have to be as accurate as possible. You have to be realistic in your projection. You cannot throw numbers just to attract investors. Remember, investors, they have experience. They have plenty of proposals in front of them. They need to select the best proposal for their money to invest in. So, inaccurate or unrealistic financial projections and inadequate financial returns will make them scared. You will push them off. They will decide, well, this guy is over-projecting. This guy is over-boosting, over-optimistic. There is something wrong in this proposal. They become afraid. And not scalable is one of the reasons of the investors rejecting the proposal. Once the business starts, the business will expand. Does your business increase with the increase in the products, sales, and turnover? Can your business handle an expansion? Can your business handle an increase in sales in a very short period of time? Or you will be stuck in a corner, plenty of requests, plenty of sales requests, sales order, and you cannot meet that demand. Investors, they need to see that your business is scalable. You can increase it. You can expand it at a very short notice. As your sales increase, you can produce more to meet the increase in sales. As the sales will increase, you can employ more people, have more investments in order to meet that demand. And that the 10th of the most important reasons, no clear exit route and sustainability. We are talking here about if the business will still be a viable business, a going concern, and controllable even if you leave, even if you, as a founder, leave the company. Will the company continue, or the company depends on your existence? The company depends on you being there running the show. Investors, they need to know that should you leave, are they left out? Will they lose the money they invested if you leave? So they need to know that you are a key person, but at the end of the day, you have to be dispensable at one point in time. This does not mean that you have to leave the business for them to gain it. No. What we are talking about here, you need to provide them with an exit strategy. Should they decide to leave, can they leave? Or if you leave the business yourself, they are left with no exit strategy and they are stuck with the business. So you have to be very clear about it, that the business will always be a going concern, even if you leave the operation.